And Arthur Kemp, who's an economic strategist at SIM, joins us now for an economic review of the week that was. Arthur, thanks so much for joining us this morning. Let's get straight into what was in focus yesterday. The ECB and BOE out with their rates decisions and a bit of guidance coming through. They're following the Fed model at this stage of assuring investors that interest rates will remain low for longer. What did you make of that, and specifically the shift in rhetoric coming through from their end?
Good morning. Certainly a shift in rhetoric, something quite new for the ECB, giving forward guidance. They did stop short of saying exactly what economic conditions they would look at, but the important point they made there was that their key policy rates would remain low for an extended period, or they even gave the hint that they could decline. So that was a very, very clear message. That whereas the Federal Reserve in the US is indicating potential scaling back of quantitative easing, and also perhaps, a couple of years down the line, I think we're still looking at 2015, we'll have to wait and see higher interest rates in the US. The ECB is certainly taking a very different line, also supported in that regard by the Bank of England, which also indicated that recent moves up in market rates were unwarranted in their view. And they will probably get some more information on them, from them in August when they release their inflation report. But certainly we also saw, obviously, the markets reacted to that. We saw the euro and the British pound selling off. So certainly different stances between the US Fed and the ECB and BOE on the other hand.
It's warranted, though. I mean, we've had the austerity having kicked in first in the Eurozone, and it seems like they're rethinking that strategy now, saying it's not working and forcing a rethink, especially where you've got data coming through from the US that's slightly more positive and putting a case for stimulus on the table a little bit more aggressively. What are you making of that improving scenario in the US? Of course, we're waiting for that non-farm payrolls number today.
The scenario certainly seems to be one of continued positive growth in the US. The data points are still a bit mixed, but certainly some of the key points have been up over the past while. We've seen pending home sales data pretty strong, and then also this week's ADP report indicated that we should get a reasonable non-farm payrolls data point today. I would hope somewhere between 160 and 180K from the non-farm payrolls data. The one bump in the road this week was the ISM non-manufacturing survey in the US, where that output index tumbled quite sharply, and that created a bit of a jitter. But I think it needs to be seen in the context of more general data in the real economy that has been showing continued positive growth. And one important aspect of that ISM non-manufacturing data release was that the employment index was up quite sharply. So if you take the ADP report and also the non-manufacturing employment report together, I would think that we should get a reasonable non-farm payrolls number today. Incidentally, in Europe, another thing to look at there, and you mentioned the austerity in Europe, and there is a bit of austerity fatigue that has been coming into the picture. Particularly, we've seen now Portugal, which has been on a program since May 2011. But there's a little bit of fatigue in there, and clearly a little bit of, on the political front, a little bit of volatility. So maybe Portugal will have to be given some more room and some more leeway on that program.
Yeah. Shifting focus to the emerging market economies, I mentioned earlier on in the show that we've had the composite HSBC emerging markets index numbers being released for services and manufacturing, and that's fallen to 50.6, and that brings us to a point where business activity across emerging economies right now is at its slowest in 4 years, Arthur. We're not looking at a 2-speed economy anymore, though. We're looking more closely at a 3-speed one.
Quite right. One of the key trends that has emerged in the last couple of months, or through this year in fact, has been the relative underperformance of emerging markets to developed markets. So in absolute terms, they continue to grow more strongly, but in terms of relative shifts, it's clear there are a couple of issues that emerging markets need to address. One of those is slowing productivity growth. Another one is costs in businesses rising, a squeeze in profitability. And then, of course, another issue, as we've seen in China recently, is the credit data, where Chinese authorities are beginning to become concerned about the off-balance sheet lending and the strength of of that and high levels of financial leverage, which they're trying to scale back, and that's also true of some other emerging markets. So generally, emerging markets are at a point where, in relative terms, their growth has been slowing relative to developed markets. And certainly I think that is being reflected in these surveys.
Let's take a look at how South Africa is fitting into this entire global picture, because a lot of concern about our own growth moving forward. We've had that PMI number locally come through as well, Arthur.
The local PMI number improved a bit on the headline, but the concerning part was that the orders data fell quite materially. Also the business activity index. At this point, it's still consistent with positive growth in manufacturing. Now, the great thing about that, of course, is that the first quarter was incredibly weak, a sharp decline. So any positive growth that we can get, and we look forward to next week's manufacturing production numbers, hopefully those will hold up as well. We saw the April number up pretty sharply from the previous quarter. Part of the reason for that, of course, was less holidays in the month. Also, we know that there was a steel plant that was down that came back online, or is coming back online in the second quarter. We also know refineries shutdowns were a drag on the first quarter data. So I would expect generally positive growth in manufacturing in the second quarter, hopefully reaffirmed with next week's number, but not essentially very strong growth. At least, though, that is better than the sharp decline we saw in Q1.
Well, let's leave it.
One aspect, though, of the data that is also a bit concerning in the PMI was that very sharp increase in the prices index. That would suggest that the sort of contained PPI numbers that we've seen in recent months might reverse in the months ahead.